owning a business is the true American dream. It's not for everyone, and it's not easy. It's not all rainbows and butterflies, but it's the preferred lifestyle for me. Setting up an entity does not mean that you're in business. It's amazing how many small business owners don't know where their numbers are.
Welcome to the Zero to Profitable Franchise Podcast, the best place for you to come to figure out the right franchise to buy and how to get and stay profitable. My name is Tariq Johnson, and I've bought, grown, and sold multiple franchises and got myself free from corporate America, and now I'm on a mission to help you do that too. Here you'll find some of the most in-depth profitable franchise secrets, tangible strategies, and specific mindsets to help you create your dream life through franchising. Have you ever heard that the IRS tax code was designed for business owners and not employees? Well, I can tell you from my personal experience that I feel like that's true. The tax breaks and opportunities for you to save tens of thousands, even hundreds of thousands of dollars in taxes as an entrepreneur are there waiting for you. And in this episode, I talked to Michael Reeder, who is a franchise industry CPA, meaning his business is specifically about helping franchise owners with their tax and accounting needs for their businesses. So we talk about two of the most common things that Michael gets asked about, which is, one, how do I choose the right business entity? And two, how do I choose the right funding? So we also dive into topics like qualifying for a mortgage once you are a franchisee and entrepreneur, and how that works, and how you need to prepare yourself today to put yourself in the right position, as well as how retirement accounts work as an entrepreneur and franchise owner in a way that you could put $58,000 a year into your retirement account. So I know that taxes aren't the sexiest topic, but if you like keeping more money in your pocket and less in the government's, then this episode is for you. So make sure to stay until the end because we cover the most exciting topics at the end of this podcast. Now, this episode is not sponsored by anyone, so if you're wanting to buy a franchise in the next 12 months, you should check out my free franchise masterclass at buyaprofitablefranchise.com. And if you want to work with me and my team on finding or buying a franchise or resale business, then you can go to tariqjohnson.com/consulting, and we're happy to see if we can help. With that said, let's jump into episode number 5 of the Zero to Profitable Franchise Podcast. All right, everyone. Today we got a special one. I'm here with Michael Reeder, who's a CPA and the managing shareholder over at Swartz and Reeder Advisors. Michael and I have connected a few times, and I just thought, wow, I really need to have him on because what he helps people with is something that's a major topic and very important to business owners. So, Michael, thanks for the time and coming on.
Hey, Tariq, thank you for having me on. It's a pleasure to be here.
Yeah, absolutely. So, just to start out, tell everyone a little bit about yourself and what you do.
Yeah, absolutely. So I'm a CPA out of the greater Chicago area. The name of my firm is Swartz and Reeder Advisors. We are a CPA firm for small businesses and individuals working with clients locally and nationwide. And over the last 6+ years, I've developed a niche as a franchise industry CPA. And I'm an entrepreneurial CPA. I've bought businesses myself, and I fell in love with it so much that I now help other aspiring entrepreneurs all across the country better prepare for their own business purchases. And so I've developed a process as a franchise CPA. I've developed a nationwide network of franchise consultants, franchise development teams, franchisors, and franchise funding companies. And I have a great nationwide network of referral partners that send me their buying candidates whenever their buying candidate wants to talk to a franchise industry CPA. And I have my free CPA consultation call where I provide a free 60-minute CPA consultation call to these buyers. And so, that's what we'll get into on this call. But I love what I do. In my opinion, owning a business is the true American dream. It's not for everyone, and it's not easy. It's not all rainbows and butterflies, but it's the preferred lifestyle for me, and it's a lifestyle that a lot of people out there strive to have for themselves, and I strive to provide value to them as a franchise industry CPA, preparing them for business ownership from the perspective of accounting, taxes, entity structure, funding, et cetera.
Awesome. Well, thanks for that debrief on what you do and who you serve. And Michael had reached out to me on LinkedIn a while back, a couple months ago, and my inbox, as probably most do, get blown up on LinkedIn with people hitting them up, and I literally never respond back to people. And I've had so many clients and non-clients of people who just follow the YouTube channel reach out to me and ask me, what entity should I set up, and what should I do for taxes or this and that. And I am so, there's so much general advice out there, and I always I hate when people ask me very specific questions to their situation, where it's like, I can't help you because I don't know enough about your situation. But hopefully we can kind of dive in and break some of the confusion that exists out there. So let's start with, with really kind of topic number one, which I'd say is entity. And I'll preface with that. Here's the thing. A lot of people confuse setting up an entity for actually making significant progress towards their business goal and dream. Right? Because there's people that sometimes set up an entity and they're like, I own a business now. And so like having just an entity with no like revenue or anything like that is not technically really owning a business. But let's talk about that a little bit, because people talk about should I start an LLC? Should I start a C Corp? So, different things like that. Can you talk a little bit about the benefits of creating an entity overall, as opposed to just owning a business in your personal name?
Absolutely. Great question, Tariq, and thank you. And just to take one step back and set the table really quick, when I have these free CPA consultation calls with buyers, they're 60 minutes. And the purpose of the call is for me to answer any questions the buyers have in the context of accounting, tax, entity structure, funding, financial projections, resale, financial statement, due diligence, if applicable, if it's a resale, or item 19 of the FDD and or item 21 of the FDD as it pertains to the candidate's business investigation and investment. And with all that being said, the topic of entity structure and funding are the two most commonly discussed topics on the consultation calls. And so entity structure, like to your point, Tariq, like just setting up an entity does not mean that you're in business. It's like it's not that difficult, and it doesn't mean that all of a sudden all this like massive amounts of revenue is going to pour through the doors. It's much there's much more to that. But for sure, so entity structure, whether someone sets up at I get questions all the time. Hey Mike, should I set up as an LLC or an S Corp or a C Corp or a partnership, sole proprietorship, and why? Like, hey, Mike, I heard that I should be this because of X, Y, or Z, or Mike, I heard I should be that because of X, Y, or Z. And so I definitely lean into entity structure and funding as the most two commonly discussed topics on the consultation calls. And so to answer your question, Tariq, so the reason why someone would want to structure an entity that has its own separate federal employer identification number, aka tax ID number, separate from their social security number, is mainly from a liability perspective. So I'm not a lawyer, so I'm a CPA, I'm the tax guy, but anyone will tell you that it's always good practice to set up your entity with a tax ID number separate from your social for liability purposes, to establish that separation, that degree of separation between you, the individual, and your business. And to set up, and then, God forbid, if there were ever anything going on with the business where there was a plaintiff, that was suing your business as the and your business is the defendant, creditors pursuing your business, trying to file a judgment. If there was any way that they could pierce the LLC veil or the corporate veil and pursue your personal assets, then that's always bad news. So that's not necessarily really a tax reason. It's not really a tax, more of a liability thing as to why it's always good practice to have your business in an entity separate from you individually with its own identification number that's not your social security number.
Yeah, awesome. Thanks for breaking that down. And what are some of the benefits from a tax perspective in terms of having an entity and different either write-offs that may be available or different tax strategies that someone may be able to utilize, simply by having the separation between entities?
Yeah, absolutely. Great question. So, as I always tell people, the Internal Revenue Code is written for the self-employed. It's written for the business owner out there compared to, for example, that person who is just a corporate W-2 employee. And what I mean by that, so first and foremost, the difference between those two taxpayers, right? Like number over here, like the self-employed business owner versus the corporate W-2 employee. The self-employed business owner can write off all of his or her business expenses. So anything that's a business expense reduces the bottom line. If you're just a corporate W-2, and by the way, there's nothing wrong with being a corporate W-2 employee, right? Like again, like the more that people talk to me, like they realize I'm very big on, weighing the pros and cons of everything, right? Pros of being a corporate W-2 is, you have benefits, maybe you can just work from 9 to 5 and then turn the work switch off, from one entrepreneur to another, Tariq, that like oftentimes that switch doesn't go off. We gotta always try our best, but it's not the 9 to 5. So, being able to, when you have an entity, whether it's structured as an S Corp, an LLC, a C Corp, any business expenses, you can write off dollar for dollar to reduce the amount of income that's subject to income tax for your entity. And then, if you're structured as an S corporation, there is a potential to save money in what's in a tax that's called self-employment taxes. Now, self-employment taxes are different than income tax. Self-employment tax is another word for Social Security and Medicare tax. So if you're structured as if you're taxed as a sole proprietorship or a partnership, then all of the net income from those types of entities is subject both to income tax and self-employment tax. If you're structured as an S corporation, then you can control the way you pay yourself to only pay the self-employment tax on a piece of the profit as opposed to all of it. If you're taxed as a C corporation, if you want to take money out, you could take money out either as salary or dividends. And there is this unique structure in the franchise and business resale world that I'm sure a lot of people that are listening to this episode have heard of, but if not, we all try to, it's an opportunity to learn something new, but it's called the ROBS program, the rollover as a business startup. And that's a structure that requires you to be a C corporation. And it's essentially a self-directed 401k. It's a way for you to use your retirement assets for your business now. And there are certain, there are pros and cons of that structure as well. But I would say that the main, the key value prop of being structured, of being self-employed, and having an entity separate from yourself personally, is number one, the ability to just write off all your business expenses to reduce your taxable income, and then getting back to that topic of liability, doing it in a separate entity with a separate tax ID number. So so you're protected from a liability perspective. So anyone can't go after you. Now there are ways to pierce the veil, and we can always talk about that. You have to be able to, you have to make sure that you don't commingle your books and you keep your corporation or LLC in good standing with the Secretary of State each year. But those are the main things to take into consideration as to the benefit of having your business in a separate entity that's not your Social Security number.
Yeah, awesome. Thanks for breaking that down. And yeah, I know that, my wife and I, we've experienced a lot of benefits we have multiple businesses, and my wife has been an entrepreneur for much longer than I have. And I remember her business crushing it. And because of a massive renovation project she had done in her building, she had this carryover loss that she was able to utilize every year because she did a very, very significant size renovation project on a commercial building that she owned where her business was. And it was just like, hold on, what? We're not having to pay any taxes? This is crazy. And it benefited us both. And what would happen was me, because of being a W-2 employee and having taxes set aside, and then her carryover loss, basically what would happen was everything that I paid in, we'd wind up getting back as a refund. And so there are just so many advantages to being a business owner. And then you start talking about things like depreciation and being able to leverage depreciation in your business. So certainly something to think about when you're looking to make the leap from employee to entrepreneur. If you still have a job while you have your business, there's ways, especially when you have a professional, that a professional, like Mike and his firm, can help you strategize in making the most sense, out of your situation. Now let's pivot to this topic, which is, and I want to talk, there's two things that I want to cover. One of the things I do want to talk a little bit about retirement plans. And I know we didn't talk about this, but I know you'll be able to provide some value there. But before we do, here's a mistake that I made when we opened and bought our first franchise location. Was I was like doing our own income statements, and I had no formal training in creating a profit and loss statement. I was using the franchisor's kind of spreadsheet model template, wasn't doing anything through QuickBooks. One, I didn't know what the hell I was doing, although I'm pretty decent with numbers. Two, I spent hours and hours and hours going through the transactions on the business account, putting them into the spreadsheet, creating the profit and loss statement. And I just thought I was so smart and so such a cool guy for doing my own profit and loss statements. And then a couple of years later, I realized how much of an idiot I was for doing that. And so one, it's really not that expensive to have someone do your books, generally speaking. Two, you want to make sure you have a professional doing it. So Mike, can you talk about what can, for the novice who has no idea what a financial statement even is, what is a profit and loss? What's a balance sheet? Why is it so important to the business?
Absolutely. So a profit and loss statement is a financial statement that shows your operating revenue and your operating expenses and your operating profit. So income and expenses are shown on the profit and loss statement, aka the income statement. The balance sheet is a financial statement that shows a snapshot in time. So back to the profit and loss statement really quick. That's from like a range. That's from January 1st of the year to December 31st of the year, and the revenue and expenses for that 12-month period. It can be any period, but it's usually a range of several months or a year. A balance sheet is a snapshot in time. So like as of 12/31 of year one, or as of July 31st of whatever. It's just a snapshot in time of your assets, your company's assets, liabilities, and equity. So your assets are, like how much equity do you have in your assets, and how much are your assets leveraged by third-party debt? So that's what the balance sheet shows you. Then there's also another statement called the statement of cash flows, which shows the different cash flows of your business. So there's operating cash flows, financing cash flows, and investing cash flows. But let's focus, like to your point, Tariq, the two main ones to focus on are income statement, aka profit and loss, and balance sheet. And why they're important is because as to all you viewers out there, as I'm sure you've heard the cliche, as a small business owner, you want to know where your numbers are, and it's true. And while that's true, it's amazing how many small business owners don't know where their numbers are. It's amazing how many small business owners make day-to-day business decisions based on just logging into their business bank account and seeing how much is in the bank account and making decisions from there, as opposed to looking at a perpetually updated set of financial statements, like an income statement and a balance sheet. Income statement synonymous with profit and loss statement, and so they're important for business owners because they really the income statement and the balance sheet always really do, as a business owner, let you know where your numbers are. see, are you making money or are you losing money? If you're making money, how much are you making? What assets do you have? What debt do you have? How do you have to allocate that profit? Do you have to allocate a chunk of it to servicing debt? Are you in a position to take distributions as a shareholder of the business? Do you have to reinvest in the company? How much do you have to reinvest? Where are you overspending? Where are you overspending? Your bank account's not, like, if you just log into your bank account on any given day, you're not going to know that you're overspending in advertising or you're overspending in office supplies. But if you have a perpetually updated profit and loss statement and you have ratios of the expense category totals as a ratio of gross revenue, you can see, well, this tends to be higher than industry. I shouldn't be spending this much in this specific expense account. Or, wow, did we really blow that much in meals and entertainment last month? Holy smokes. Like, when you see it, so the financial statements, as opposed to just logging into your bank account, tell the whole story and really allow you as the business owner to make decisions. And so my advice to business owners is to really, like one of the first things that you do when you get in business is to work with a professional, to work with a CPA like myself, to really take your books seriously. So I'm a big fan of QuickBooks Online. So get a QuickBooks Online account for your business and get the chart of accounts set up, and there, it's 2021. So and we're only moving forward into the future. So, a lot of things when it comes to the bookkeeping, just like anything, when it comes to bookkeeping, utilize automation and technology as much as possible to not only make the books as accurate as possible, but also to eliminate all of this time. Like, Tariq, you were saying how, when you first started out, you spent hours and hours doing it yourself. And, leveraging automation and technology, like syncing the business bank accounts to the QuickBooks Online accounts, syncing the business credit card accounts, syncing the payroll processing software to the QuickBooks Online. All of that stuff, it allows the books to be done with a high degree of accuracy, as well as efficiently as possible. And to do all of that, and to view the company's books as not just this thing that has to get done at the last minute to give to your CPA so he or she can file the taxes, but to view the books as an internal management tool. If your books are updated, then of course it's going to make tax time easier, because then you just pass the books over to your accountant. But then also, if your books are perpetually updated, then you can also have that proactive tax planning conversation with your accountant, not just, here are my books to file last year's taxes, but beyond taxes, whether it's actually filing taxes and tax planning, to actually look at the books and have a CFO related conversation with your accountant, to actually look at the cash flow of the business and make management decisions. What can we do to increase profit? Because everyone out there, we all know we have to file our taxes, and everyone wants to do whatever they can to save money in taxes and be proactive with tax strategies. But at the end of the day, business owners care about making money. That's what really opens up listening. That's what really people are interested in. And people know that they got to do this tax thing. And my firm is a great resource for all things taxes, but we're also a great resource, in that capacity of that fractional CFO. So it's yes, taxes are important, but let's look at the books and say, okay, how can we increase revenue? Where can we decrease expenses? How can we increase profit? And so that's not really a tax conversation. Of course, taxes are part of it, but in conclusion, to really take the bookkeeping seriously, because if the books are perpetually updated, then it makes that tax conversation streamlined. It makes that CFO conversation streamlined. And if you don't, and it's amazing how many business owners out there, are fall into this category of they procrastinate on their books, then it makes those conversations difficult. If you don't have a sound bookkeeping system, if your books are not updated and accurate, then it makes the whole tax conversation almost impossible to have. And it makes that CFO conversation almost impossible to have. So the books are the foundation of the company's internal controls, and they're very important, and understand that from day one. That's advice that I give to every business owner out there.
Yeah, it's great. It's great advice. And Here's what I'll say very clearly and directly. If you as a business owner are not hiring someone else, hiring a firm, tax accounting firm to do your books, you're wasting your time and you're making being a business owner harder on yourself. Usually it's not very expensive. Depending upon the complexity of your situation, it can be as cheap as a few $100s a month sometimes. And so to spend hours trying to figure things out and even spend time in QuickBooks, I think is a complete waste of time. And think about, from an entrepreneur, what your value is in making decisions and growing your business. If you're spending even an hour or two a week on trying to figure out stuff with your books, that's time wasted that you're not spending on your business. And, that was really very insightful around the tax planning standpoint. I can't reiterate this enough as someone who for a couple of years didn't really have those things in order. And now, it's funny. I was just talking to my wife about this and saying that we have weekly family meetings, me and my wife, so that we can plan our life as a couple and as entrepreneurs and vacations and our family life. And so I said, hey, we need to also start having monthly meetings where we share our business P&Ls with each other so that we can be on the same page and balance sheets so that we can be on the same page on where each other's businesses are at, how they're performing, and so we can plan. Because as an example, we set a plan and a target that in 2023, we are going to buy our dream home. And so in order to do that, that takes planning. And we need to make sure that we're not just like having a bunch of write-offs. I've seen this, and I'm sure you have too, where people, they're great at getting write-offs, but what happens? They're so great at write-offs and depreciation that they show such little profit, and then it can be very challenging getting a loan. So there's ways that you have to plan around that. And so I'm already thinking ahead going, okay, well, we need to make sure that we're setting ourselves up and showing enough profit and not just crushing it with write-offs, so that once we're ready to pull the trigger, it makes it very easy from a lending perspective to get approved.
That is, that's a mic drop right there, because there, and especially, and so I've learned both through my own refinance and real estate purchases, and also working with my clients, the residential real estate underwriting process for getting a mortgage is it was already difficult for self-employed people compared, like if you're just a W-2 and you're trying to get a house, you just need to provide the lender with 2 years of tax returns and W-2s and and 2 months of your personal bank account statements and 2 months of check stubs, and you're done. But if you're and COVID made it even harder for self-employed. So if you want to get if you want to get approved for a mortgage and you're self-employed, then you're going to have to submit prior 2 years of tax returns, as well as W-2s and K-1s, and then also a current year interim financial statement. So like if Tariq and his wife are applying for a mortgage now, they're going to have to supply 2020 and 2019 tax returns. And, let's just assume that, it's August 31st right now. So then also interim 8-month P&Ls for the first 8 months of 21. And then those P&Ls are also going to have to be supplemented by 2 or 3 months of the business bank statements as well. And so what they do is they take a 24-month average from the prior 2-year tax returns, and then your current year financials, the monthly cash flow from the current year financials have to be at or exceed that 24-month average from the prior 2 years from the tax returns. And it has to be trending within the two most recent months that are supplemented by bank statements. So if your average cash flow from the 24 months was like, 10,000, and then if you were to submit your financial statements for the 8 months of 2021 and they were trending in at 9,000, you would have a problem. Like your self-employed income would be at risk of not qualifying towards the debt to income ratio that you would need to get approved for the mortgage. So it's COVID only made it worse for self-employed borrowers from a residential lending perspective. And so that's why you really have to think about this stuff, like like the fact that you and your wife Tariq are having these monthly meetings. Yeah, you have to position yourself to get pre-approved for that mortgage for your dream house. Because if you don't, like there's like you could really, you could like, so 100%. It takes like, it's much more easier to just, in that context, it's easier to just be corporate employee, just W-2s, check stubs, and it's done. They're going to just go with that. But when it's self-employed, it adds this whole layer of complexity to the residential mortgage underwriting process.
Yeah. It's so true. And before I fully transitioned out of my last corporate job and finally made the official leap from employed entrepreneur, we took out a home equity loan, and I made sure that we did that before making the leap, because I knew once that was it, I was going to need 2 years of records, right? Which is, once you're an entrepreneur, good luck getting a loan if you don't have 2 years of history. So before you transition, get your loans now, refinance now, get your home equity line of credit now to put yourself in a position. And this is one of the things that, I teach my clients is you got to strategize. Sometimes I've had clients where they're like, I'm going to put in my 2 weeks notice. And I'm like, whoa, hold on. We got a plan. We got to have a strategy. I get that you're fed up and you're frustrated. We got to be smart. You make emotional decisions like that, and you don't realize what the consequence of those decisions are. So another topic that I think is very important, and something that, going back to my financial advising and banking days, is entrepreneurs really struggle with retirement planning. And I think it's a combination of a couple things. I think one, people in general aren't great at retirement planning when they're an employee. So there's just an overall intimidation, lack of knowledge. But two, people have no idea what's even out there from a business owner perspective. And oftentimes the plans are even more attractive than if someone's a W-2 employee, when you start to think about something like a SEP IRA and how much you can actually contribute. Can you talk about business retirement plans and from the role of how your company might help your clients in kind of strategizing and figuring out the options, how much they can contribute, all that stuff?
Yeah, absolutely. Great question. I am a big proponent of using your self-employed business as a vehicle to accelerate your retirement savings. And so again, when you're a corporate W-2, you can participate in the company 401k plan, and depending on your age, if you're less than 50 years of age, in that context, you can put away $19,500 from your paycheck, and then the company usually has some sort of employer contribution, whether it's a match or a safe harbor or a profit sharing or any combination of it. But you have that option to have a self-employed 401k plan for your business as well, for your self-employed business. But you also have much more discretion over the employer contribution that you can put in. So, I mean, depending on the industry, like for example, I'll use service industry as an example. Now, this doesn't mean that retirement plans don't apply to brick and mortar retail, but more, a service industry is more of an example of where, like, if you're crushing it, right? Like, if you're a real estate agent, or if you're, if you're a franchise consultant, or if you're a business broker, if you're an expense reduction analyst, right? Like for one of those brands, like a Schooley Mitchell, or a P3. I'm just like dropping some like franchise brands out there, like any sort of service industry. If you're in home inspection, service, like compared to brick and mortar retail, where you might have capital expenditures where you can do accelerated depreciation, a service industry, you may be in a situation where you made all this money, which is good, and you wrote off all your expenses, right? And maybe you even accelerated some of your expenses from Q1 of next year, right? Like you're in Q4 and you're like, holy crap, I just had this great year. Well, let me prepay some of my 2022 expenses, to chop down this profit. But like you do all that and you're still looking at this huge profit. What else can you do? You get to the point, you can't buy this huge piece of machinery because it doesn't really make sense, for like a real estate agent to like have a huge piece of machinery, like if you, as opposed to like if you were like a manufacturing company. What do I did everything I could. I still have this monster profit. That's, self-employed retirement strategy, and make massive contributions to your self-employed retirement plan. So have a self-employed 401k and do the full deferral. Can you justify your spouse being involved in the business at all? If so, if you can justify it, put him or her onto payroll and max them. Yeah.
Can you give sorry to interrupt you. Can you give an idea? Because I think people are going to be blown away by this. Can you give an idea of what type of level of contributions people can make to these plans?
Oh yeah. So, I mean, if it's a 401k if it's a 401k, then you can do, I'm assuming that you're under, like if the person's under 50, they can do 19.5 out of their paycheck. If they're over 50, they can do an additional 6,000. So 25.5 out of their paycheck. But then they also can do ballpark, 25% of their salary as an employer profit sharing contribution. And so it changes each year for inflation, but a max 401k for someone under 50 in 2021 is approximately $58,000. So that means that if you were to, and you would have to take a salary of approximately 130, 140,000, but still, I mean, like the more salary that you take, you're paying more money that's, subject to 15.3% Social Security Medicare tax, but then you're also able to put more dollars away and shelter them from income tax, which depending on which state you're in, federal and state may be well above 32%. Like it may be even tipping 40% if you're in a state like California, New York, or Illinois. And so, but yeah, like you could potentially put away up to 50 grand, like 58,000, if you take a salary of approximately 130 from your business, and that's huge. And then it doesn't stop there. You could potentially put in what's called a defined, like if you have enough free cash flow from your business, and then you can stack what's called a defined benefit plan on top of your 401k. So a 401k plan is the most commonly known plan that's considered a defined contribution plan. And then there are these plans that are called defined benefit plans, which are pension plans. And a common one is called a cash balance plan. And a cash balance plan allows you to put away, it's based off of like these like complex actuarial tables, and it allows you to put away an extra chunk of change into like and like it depends on how much you set the limit for, but you could potentially put another 30, 50, 70, 100k on top of the 401. It's massive. And then you can put provisions in both the 401k plan and the cash balance plan that allow you to make a chunk of your contributions as Roth as opposed to pre-tax. So you can, because the Roth, the regular Roth IRA, number one, if you're less than 50 years of age, you can only put away $6,000 per year. But if you are, but depending on how much money you make, you may not even be able to qualify to put money into a Roth IRA. Now, there's a workaround that for the Roth IRA called a backdoor Roth, which you pretty much, you make a non-deductible IRA contribution and then immediately roll it over into the Roth. But still, you're only limited to $6,000 a year to do that. And so there are ways that you can make large Roth contributions inside the self-employed retirement plans, 401ks, cash balance plans. They don't just have to be pre-tax. And with all that being said, so I'm a big proponent of so for example, for myself, I'm 34 years old. And every year, me and my wife, we max out our IRAs and we max out our 401ks, both salary deferral and as much as profit sharing as possible. Like I plan on in the next couple of years stacking a cash balance plan on top of it, and just because, like, for example, my brother is a Chicago police officer, so he's got a nice pension waiting for him as he gets into his 50s and 60s. I don't, so I have to make my own. But because of but by going heavy on self-employed retirement plan strategy at this, at 34, as opposed, to just getting around to it at 50. And by the way, there's no time like the present. So if you haven't done it up until now, regardless of what age you are, start. But It's a real in-depth conversation, Tariq, and you can tell I'm passionate about it, but there is so much there to like when it comes to using your business as a vehicle through which to accelerate your retirement savings through life, because you can do
Yeah.
so much more compared to if you were just a W-2 employee at a job.
Yeah. Man, that was epic. I mean, I was like, I'm leaning on the edge of my seat here because it's such an exciting topic for me, especially as someone who has had their investment licenses for 14 years now. Just the overall retirement topic, man. I mean, as an entrepreneur, it's epic. And the fact that someone, if their business is doing well enough, profiting enough, that you can put aside $50,000+ a year towards your retirement. I mean, wow. And that's money that you're not paying taxes on, that you're able to defer towards your later years when hopefully, or maybe not, it would be a quality problem if your tax bracket didn't reduce in retirement. That means you're still making a lot of money. So that's what I would call a quality problem. But I think this is such a massive topic, and we didn't plan to cover this topic, but I'm so glad we did. And obviously Mike is a true expert to be able to just drop bombs like that off the cuff on retirement plans. But I think we'll leave it there, Mike, because I think that's a really exciting topic to cap off and finish off with. So for everyone out there that's watched this, Mike, where can everyone follow you or get in touch with you if they wanted to set up that free consultation call or just kind of keep track of the content and information that you provide?
Absolutely. So my main social media presence is on LinkedIn. So find me on LinkedIn, send me a connection request, Michael Ian Reeder. My middle name is Ian, I-A-N. So Michael Ian Reeder, LinkedIn, send me a connection request. Would love to connect there. My company website, Swartz and Reeder Advisors. So swartzreeder.com, SWARTZREEDER.com. My email address, send me an email, my first and last name, Michael Reeder at swartzreeder.com. So you can just, if you're listening to this, if you're watching it, you can play it back, but it's Michael Reeder at swartzreeder.com. Again, that's SWARTZREEDER.com. My business phone is 847-241-5800, extension 2, and my cell phone, 847-302-3397. On that cell phone, you can call me, you can text me, and just, if you need to hear any of that, just play it back. And I'm here. Reach out to me. Would love to connect with you. And if you're coming from Tariq's ecosystem, then that makes me really excited to listen to get to know you, because I've known Tariq for a few months now, and Tariq, it's been an absolute pleasure getting to know you. Are doing great things in the business resale and franchise space. Helping aspiring entrepreneurs, helping current business owners thriving. Your YouTube presence is amazing. So thank you, Tariq, for all the value that you provide the ecosystem here, and keep doing great things.
Awesome. Thanks, man. Appreciate it, brother. All right, guys. Well, that's a wrap, and let's make sure to get your money and finances in order, and make sure to reach out to Mike. We'll see you guys on the next one.